Hello, my name is Alan, and this is my presentation on why LTCM failed. Long-term capital management, or LTCM for short, was established in 1994 and became the biggest hedge fund of the 90s, managing $4.7 billion in equity and giving investors an average 30% yearly returns before they had to be bailed out in 1998 and slowly liquidated into the early to mid 2000s. Now, what made LTCM such a dominant force was definitely its members. You had names like John Meriwether, who was the former vice chairman of the Salomon Brothers, or David Wiley Mullins Jr., who was the former vice chairman of the U.S. Federal Reserve, or Myron Schlons, who was a future Nobel Prize winner of economics. Them, along with their team of their partners in that were former Salomon Brothers members, which was an investment bank, one of the top 5 investment banks in the 80s and 90s, until they were bought out by Citibank in the early 2000s. So the strategy that the team used was convergence arbitrage. Basically, what convergence arbitrage is, they would short or they would sell on-the-run U.S. Treasury bonds, which were just issued. And these U.S. Treasury bonds would be more expensive due to its liquidity premium. People would trade it a lot, so investors who wanted their investments to be more liquid would pay an extra for this. Now, old off-the-run bonds, they would long, or they would buy for the long run. And these would increase in price or pull up to par because bonds trade at a discount based on their yield or return. But these discounts must return to normal as the bond runs out and the government has to pay back your initial amount. So the prices converge. The new bonds will come down because of the liquidity premium, and the old bonds will go up because of pulling to par. Now, these were minuscule gains, very tiny. So they needed high leverage to make significant progress. For every $1 in equity that LTCM had, they were managing about 40 times as much money in their positions. And this was a market neutral strategy, meaning that no matter if like the true interest rate went or the true value of the bond went up or down, LTCM would still benefit, which is why it was regarded as a super safe strategy. Now, there were some underlying flaws to this, one of them being low transparency regarding its risk profile. You see, LTCM was made in the 90s, where there was a lot less regulation over hedge funds. Therefore, they did not disclose a lot of their information. But this was largely ignored because of their high returns. Another problem they had was having surface level diversity, but high correlation among around 80% of their positions. These positions being investments in G7 country bonds, countries like America, China, France, Britain, and these would all move in the same direction in the one incident that caused their downfall. They also had trust in flawed VAR risk modeling, and they used limited historical data to build their models, which I will touch on further. Now, what bankrupted LTCM was the Russian financial crisis. One of their positions that they had was GKO bonds. They would long the GKO bonds, and to protect themselves from a collapse in the Russian currency, they would short the ruble via future contracts. Russia had issued short-term GKO bonds, which had interest rates of 40% all the way to 100%. And these high interest rates were due to the instability of the currency. So they needed the high interest rates to attract investors. Now, LTCM saw this as a great opportunity to make money. But to mitigate risk, they entered future contracts with Russian banks to have a fixed rate forex conversion between rubles and USD. This way, even if inflation was crazy due to these high interest rates, they would still be able to convert the rubles, the unstable rubles, back to the more stable USD at a fixed rate. But in 1998, when there was the Russian financial crisis, Russia devalued all of its currency and it stopped all trade of the ruble, which made all of their future contracts useless, leading to 100% of the investment as loss. Now, LTCM had about 8% of their portfolio in GKO bonds. So although this is significant, this did not kill LTCM as many people think it did. Instead, it was their second position in US Treasury bonds that killed LTCM. Now, they were doing convergence arbitrage mentioned before on these Treasury bonds. And when Russia devalued its currency, there was a flight to quality as investors purchased the most liquid, on-the-run US Treasury bonds, the ones that were just issued. And prices skyrocketed, making its short positions of the on-the-run bonds lose a lot of money. LTCM was essentially the strategy was betting that the two bonds, the on-the-run bond and off-the-run bond, would converge. But as the on-the-run bond got more expensive, the prices diverged. So they suffered significant losses. And this was a large portion of their portfolio. So this causes devastating losses to LTCM, where over half of their equity was wiped out in a month. Now, not only that, they faced outside pressure. Institutions like AIG were motivated to short squeeze the fund, or essentially seeing that their positions weren't working and taking advantage of it. And some of these institutions did it for the reason of wanting to buy out the fund to acquire its modeling secrets, and others simply wanted to just profit off of their weakness. According to an interview of the partners of LTCM by the New York Times, they said that Wall Street firms began to short squeeze the fund's position, making it difficult for LTCM to unwind. LTCM didn't see this coming because of their models. Their models regarded the Russian financial crisis to be a 10 standard deviation event, which is 1 in 66 sextillion, or 66 and 22 zeros, which was not happening in the history of the universe. This was largely due to their models using only 5 years of training data, which did not include any financial crisis. Additionally, most of Wall Street was copying LTCM's trades, which made the distress even worse, as all the major financial institutions were now trying to unwind the same positions that LTCM was in. And lastly of all, in theory, prices would converge eventually. The thing that LTCM was betting on would happen eventually, but investors don't wait for eventually. Illiquid securities were made to market because scared investors were pulling out and making margin calls. And the more illiquid securities are sold, the worse their financial sheets were going to be, and more margin calls were going to be made in a vicious cycle. LTCM in 1998 received a $3.6 billion bailout funded by Wall Street and coordinated by the New York Central Bank, and was liquidated over the next few years. Now, what changed after the collapse of LTCM is that there is a shift from usage of value at risk modeling to conditional value at risk modeling. You see, the value at risk modeling calculates the amount of money lost at the 1 minus X worst loss. So for example, a 99% value at risk would result in the 1% worst loss day, and it would tell you what that is. But after LTCM collapsed, conditional value at risk was used, which reveals the entire tail risk by adding the most extreme worst X%, so 1% of days, to account for all of the most extreme losses. Additionally, LTCM created a massive impact because of their high leverage. So the maximum leverage ratio for funds was reduced to prevent another potential financial collapse as big as LTCM. And hedge funds became more heavily regulated in order to give more transparency to their investors. Thank you for watching.